thank you so much for all your patience. So we just got to get past those technical things sometimes. But that's part of trading too, right? So having to deal with the technology. Okay, well, first off, I want you to know, my name's Darrell Martin. I'm with Apex Investing. I'm a TradingPub commentator. I also have a daily radio show from 12 to 1 Central, 1 to 2 Eastern. And we broadcast that. It's broadcast in a lot of places, but it's also like right inside of our website. And we have a free membership. You're probably going to want to learn more after this. And if you just go to apexinvesting.com/pub, and you'll be able to get access to additional information. Obviously we have all the standard, risk disclaimers, trading involves risk, make your own decisions, etc. This is original content. This is actually, what I'm teaching you today is the first strategy I came up with when I learned about Nadex. And I studied it for several months, and I tried to figure out, okay, what's the best way to take advantage of this product? And it's actually the very first strategy I presented, I think, like two years ago at the New York City Trading Expo. Maybe 3 years ago, actually. But and of course, futures, options, swaps, etc. Involve risk. So one thing that is really cool, if you're just trading Nadex, and we'll be talking about Nadex, but also about how to, more specifically, we'll get into how to apply it to futures and forex for hedging your futures and forex trades. The Nadex trades themselves all have a capped risk. Okay. So let's go ahead and get started. Everybody has seen a chart like this before, and they've went in and they're like, okay, it looks like the market's moving here in a downtrend, and so I think I'll go ahead and sell, and I'll probably target this level right down here, right around 1.5585 or so, 1.56, and so I'm going to go ahead and enter at this price level. And I'm going to put my stop. I hate getting stopped out, and so I'm going to really put my stop far away. Maybe it close, maybe put it far away. You're just sick of getting stopped out. So you put your stop above the last high. You're like, hey, if the market goes that high, I'm definitely wrong. I should be out of the trade. And you put your stop up there. Well, if you did this on one lot, which is 100,000 units of currency, and you sold at 56.85, you had your stop at 57.50, you'd be putting up about $650 in margin, $650 in risk on the trade, and $3,000 in margin if you have 50 to 1. On your, say your forex account. Now, if you're outside the U.S., you may have much higher leverage. If you use futures, you may get better leverage. But just spot forex, 50 to 1 leverage, you'd be looking at about $3,000 to do the trade for 100,000 units. Now, you can also do a tenth of the size and do a mini lot with $65 risk and a little over $300 in margin. And so you put your trade on, and what happens? We've all felt that probably in the last week or two. And the market, this is one of the most painful parts right here, right? The market's just tick, 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 going up, going up. You're like, oh, come on, come on. And you're thinking, here's what starts happening to you as a trader. Should I move my stop? Because looking at everything else it's saying, it looks like it's definitely going to pull back. Well, that usually ends up killing you. It works a couple times, and then it wipes you out. Okay, so if I do get stopped out, should I go short again? Or am I just fighting the trend? Or you're going, okay, maybe I should just go long because the trend's obviously going up now. Or you just go, I'm just going to set aside because I have no idea what's going to happen. And then all of a sudden you see the market go right back in your direction or take off, and you missed out on a massive move for the day. And you're like, I knew I should have kept trading. And the next time you trade, then of course you make the wrong decision and you get stopped out again and again and again. And so it jacks with you psychologically as a trader to have to deal with that every time something's approaching your stop. And what messes with you even more is the next thing, right here. You ever had that happen to them? It goes up, it just perfectly hits their stop, and then bam, does exactly what they said it was going to do. Like, I said it was going to go down here. I knew it. I was right. I just didn't have time to be right because I got stopped out before it. Man, if I would have moved my stop, that would have worked better. Of course, next time you move your stop, and what happens? It hits you. So I'm sure we have some actual live traders in here, so everybody can attest that this is an ongoing problem as a trader. Is that correct? Try to get a little bit of interaction going here in the room. So a few of you occasionally have an issue with with having stops hit and messing with your psychology. What are you going to do on the next trade? And on and on. And so it really is something that we're always trying to solve as traders. And so what I'm going to teach you today is not how to never lose again. Okay, it's how to never get stopped out again like that. How to get a stop loss where you're only risking, say, 10 or 20 ticks or pips but you're getting, 100, 150, 200 ticks in protection. So literally less risk and larger stop loss. All right. So we're also going to go into 3 important things that you need to know to actually consistently make money in trading. Like I said, we're going to talk about how to reduce your risk by up to 75% or more, but have stop losses that are 400% or larger, which sounds like Morgan said earlier, a complete typo. But this is actually what you're going to learn today. It does work. It's pretty awesome. I love doing it. It's probably still among, if not my favorite strategies today, because at heart I'm still a futures and forex trader. And stop losses for pennies on the dollar. We're going to go into that, and then we're going to talk about the ultimate hedge strategy and spreads, and Nadex specifically. So one thing I want to always let you know, you don't want to miss any of these steps. Obviously, if you take notes, like in anything, whether that be on a notepad or Word or write them down, whatever you like, you'll retain more information. And to keep things moving, I'll answer questions as they apply, and I'll answer all questions no matter what at the end if I missed any, okay? So I do want to make sure that I get all of your questions answered. One other thing I would like to tell people is, this is going to be very new to you, okay? So don't feel like you're alone, and we'll talk about that here in a minute. To make money in trading, you need to learn 3 things. You need to reduce your risk, because survival is the #1 rule in the game, okay? So you have to reduce your risk. And there's several ways to reduce your risk. Obviously, not taking bad trades is one of them. That seems the most obvious, but the most difficult sometimes. Also, of course, making sure you have proper, position size is another one. And then having a proper stop loss would be another one. But also not having to take a stop loss that's too close is a huge way to reduce your risk, but still not increasing your risk at the same time. Again, that's our focus today. Also, you need to increase your leverage. You want as much leverage as you can possibly get. And so I'm going to show you how massive the leverage can be, depending upon how you decide to use the hedge strategy. There's a lot of ways to use it. And you need more time to be right. A lot of times you're right about market direction, but it goes against you before it goes in your favor. And, so make sure you take that down. I want to reduce my risk. I want to increase my leverage. I want more time to be right. And again, this is new information. It's normal to feel overwhelmed. I'm going to break everything down, step by step. I'll answer any questions you have, and I have a website, a forum with literally hundreds of videos. And I do free webinars every week. I have one tonight again at 7 o'clock. I have ones on Thursday mornings. I do bonus webinars like this with Morgan. And so again, step-by-step videos. Right now, the #1 thing, hey, if you can follow along and you can keep up, awesome. If you feel like you're trying to get it, just try to grab the concepts, okay? Because once you grab the concepts, you'll be like, this is worth me spending a little bit more time, maybe watching that video a few more times, maybe hopping on and watching some of those basic videos and learning how to do this. So you might be able to keep up with all of it, but if you can't, just make sure you're following the concept, the idea, okay? Now, what we're talking about is what's called a Nadex spread. And a Nadex spread is available to trade on the Nadex exchange. The Nadex exchange is located in the United States. It's regulated by the CFTC, which is the same regulatory body that regulates the CME, like for futures. The accounts are in the U.S. There's a lot of good reasons to trade on Nadex. Nadex has 2 kinds of contracts. They have binaries, which are actually price ladder binaries. They're not your call put binaries like the bucket shops have overseas. And they have spreads. They're completely different instruments. Okay, so a lot of people know about the binaries, but they have no idea what the spreads are. We're talking about the spreads. It's completely different instruments. Try to compare a future to an option or something. It's completely different. You can't say the 2 are the same. And the beautiful thing about these spreads, they're sort of like a call or put option, meaning, I buy it, it goes up, I have capped risk. I sell it, it goes down, I make, profit, I have capped risk. But they don't have all the complexities you may have heard of in Greeks. You don't have to deal with, delta, gamma, theta, vega. The reason is because they all expire within 1 day or less. Okay, sometimes within hours or minutes or, whatever. It's depending on which one you want. But they have basically 23-hour expirations. And then they have new ones that come out every hour depending upon which market you're looking at. And it's basically the spread by itself, which first we're going to make sure you understand what the spreads are. and then we'll make sure that you understand actually how to apply them as hedges. The spreads themselves are simply an instrument just like a future or a forex contract. It's a spread contract. If you think the market's going to go up, you buy. If you think the market's going to go down, you sell. Okay? And the difference between where you buy it and you sell it in pips or ticks, okay, that's your profit or loss. The big difference being that your loss is capped. And now your profit's capped at a certain point if you just do the spread. But when I talk about the hedge, we're going to show you how to have uncapped profit, but with capped risk, okay? And again, these are Nadex spreads. They call them bull-bear spreads. I call them box spreads because if you draw them on a chart, they look like an actual box. And they're currently available, just so you know, they're currently available to U.S. residents. You can sign up as an international trader for a demo account. And our website has like links on how to sign up, you know, how to set up, how to use the platform, we have a scanner that's free, how to use that. But they are going to be available to international residents soon. Here in the next 1 to 2 months, they should have future commission merchants on, and then you should be able to trade them. So now's a good time to start demo trading to get ready for when live's available, even if you're not in the U.S. This is something you're going to want to know how to do, and you don't want to wait until it's available to learn how to do it. You want to be able to use it on day one. Okay, so a good question does come up. I'm going to talk about it a little bit more here in a second. And they're not credit or debit spreads. They're Nadex spreads. So let me explain the Nadex spreads to help you. And then, you know, Bob makes a great point. In order for an option to hedge a futures position, they have to be in the same account. He says, right. That's actually, and then he says, does Nadex also allow you to trade futures? No, Nadex is an exchange. They're not a broker. Okay, like the CME is an exchange, the CBOE is an exchange. Nadex is an exchange, and they offer their exchange products, which are futures and forex, Nadex spreads and futures and forex, Nadex binaries. They do not have to be in the same account to hedge it. Now, you do have to have the drawdown in one account. Like you could go over to, you know, let's say you could trade over at Myris and buy, or I don't know, not Myris anymore, but you go over and trade at, say, Infinity and buy, and you could go over and trade at AMP and sell, and you'd be hedged. Now, you'd have a net P&L hedge, but of course you have two different accounts. So I'll talk about why that's important to consider as we progress in it. So therefore, it's not a offset margin hedge, I guess is what you're looking for, Bob. But your net hedge would still be the same. Okay, but you'll understand it as I get into it. So once we get to the hedges. Okay, so first I want to talk to you just about, you know, margin ratio. Okay, like what's your leverage? Remember we were talking about leverage earlier? If you trade, say, the euro-dollar ETF, and I equalize them all based on the futures contract to get them in, because it's at 125,000, so you can't make it 100,000. So an ETF, if you had, you know, say day trading margin, which means you have at least 25 grand in your account minimum, you're talking about having to have $31,000. If not, you'd have to have like $60,000. If you have portfolio margining, you'd have to have at least $12,500. So, and the portfolio margin account requires you, depending on the broker, between 100 and 125 grand minimum balance at all times on all positions in your account. Okay, like a balance of that amount. So very low leverage. You know, 1-to-1, 2-to-1, 4-to-1, at best really 10-to-1. On spot FX, you know, in the U.S. you're looking at about 50-to-1. Is pretty much as high as you're going to. It is as high as you will get due to NFA regulations. As high as you'll get. So you'd have to put up about $3 grand to do 100,000 units of currency. If you went over and you looked at the futures over the CME, the 6E contract, depending on your broker, you can get about $500 margin for day trading. Now, if you have it overnight, you know, then you have to put up more, so you have to close it and reopen it or whatever. Every broker is a little bit different. But the broker that I use, $500. And the leverage for that to control $125,000 would be 250-to-1. If I look over at the Eurodollar future options, such as the CME's options on 6E, and I went in and did, you know, same contract, same strike there, I'd be looking at about a 50-to-1. Okay, so about $2,500 is what I'd have to put up. So not quite 50-to-1, and to control 125,000. But it's not the exact same because it's futures, so there's a little variance there. And then over on future options, and then over on the spreads, okay, on the spreads themselves, then I could actually, on Nadex spreads, I can control 125,000 units of currency with only $250. So twice as good as what I'm getting over on, say, the CME futures at a 500-to-1 leverage. Now, obviously, every spread varies, and you'll understand that here in a moment on how much you put up. But when I was looking at these live across the board, this is what the amounts came out to. So you can see that, a lot of times we as U.S. traders are like, man, we only get 50 to 1. Well, you still can get much higher than 50 to 1. So that's available. The cool thing is it doesn't cut both ways, which is usually the issue when you're trading with leverage. So I put an example: if the market went up, for 1.25 to 1.27, just trying to do an even amount there, then you'd make 3,000 on the ETF, you'd make 3,000 on the spot, you'd make 3,000 on the future. You'd only make $463 on the options. So those of you who are options traders, you're talking about having everything in the same account, like you can do future options. Problem is you only make $463. Why? Because you have to deal with what's called delta and gamma. Because you have longer timed expiration, therefore your premium is higher. Okay, your theta, the amount you're paying for it is higher, and which means also that your gamma is lower. So, and these are really advanced terms, but if you don't know options, this doesn't matter to you. But if you want to know why, if you do know options, basically, theta is the price of your gamma. Okay, so the more theta you're paying, the less gamma you're getting. The less theta you're paying, the more gamma you're getting. What does gamma mean? Gamma means how fast does the option move. And so if the market, flew up, you wouldn't make that. It wouldn't make that much for you. It would be horrible as a hedge because it's not moving fast enough because the delta is too slow because the gamma is too small. It's not that delta is not increasing fast enough. But if you were able to get these on like Friday expiration options, maybe you've traded those before on Fridays. They're really cheap. They move really fast. They have a really high delta. Well, imagine getting Friday expiration options every day. Imagine getting them even every 2 hours if you wanted to, at night, whatever. And so now it's almost like, think of this as options for day traders, but without the complexities of options. Okay? And so the profit and loss, like if it moves down, what do you lose up, down to 22.50? Basically, you lost 3,100 on the ETF, you lost 3,100 on the spot, you lost 3,100 on the futures. You only lost 1,250 on the options out of your 2,500 risk because, again, the delta slows it down. So you still have time value in there. But you only lost 250 on the spreads because you put up less money, and that's your max possible loss that you could lose. So you can put up less money, have less risk, have more leverage, and make a very similar amount. Look how the spread made $28.75. It didn't make the full 3,000. Okay, there's about $25 a premium in there that you paid, which is nothing. So about $25 a premium that you paid to do this trade, and your risk was reduced by a massive. So you got massive leverage, but your risk was less than a tenth of what it was on all of the other choices total. Okay. Again, Nadex Exchange, all products are capped risk on the Nadex Exchange. You can't lose more than you put up in margin. Your risk is your margin. So if your risk is 250, that's your margin. Now, it doesn't mean you're having to risk it all. You could put up 250, and you could, let's say you're down $50, you could take it off. Okay, it's not like you have to hold it to expiration. Just like any option, most people don't hold options to expiration. Most people don't hold futures to last trade date, or delivery date. So they don't hold stocks until eventually the stock company buys them back. They buy them and they sell them. They get out of them. Same thing. Okay. You still get the leverage. You can do this on stock indices. You can do it on future commodities, forex pairs. So a lot of different markets. The price is driven by the underlying market, just like an option contract. Okay, it's not driven by the supply and demand of the option, the spread. As the market maker is making the market based on where the underlying market is. It's a Black-Scholes model. If it was driven by that, you'd have easy arbitrage. Okay, and they don't want that. Nobody wants to. I'd love to have the arbitrage, but arbitrage means mispricing. So if the market moves up, there has to be so much value in that contract, and so it will rise and fall with the market. And there's plenty of liquidity for most traders. I mean, if you're trying to, if you're a 7-figure trader and you're trying to go on and do, 1,000, 2,000 contracts at a time and, all that's where you can come into an issue. But until that's an issue for you, I would not worry about it. I trade pretty large position sizes. I know other guys who trade very large position sizes, and they have no issues at all. They move in pips or ticks. It's the same thing. It's a pip or a tick is the smallest increment move. Okay, and one of the really cool things, if you traded futures, you traded forex, is you have to deal with different pip sizes or tick size, or not pip sizes, but tick sizes mainly, and you have to deal with different values, right? Like it's quoted in yen, or it's quoted in, dollars, or it's quoted. I mean, on down the list, you can go down and or it's quoted in Canadian dollars or francs or whatever. So you have to do the FX conversion. Or if you're trading futures, like one tick is a quarter, it's 0.25 like an ES, and that's worth $12.50. And over on NASDAQ, it's 0.25, but that's worth $5. Over on the Russell, it's 0.1, and that's worth 10. Over on oil, it's 0.01, and that's worth 10. You have to, you got 8 cents and bushels and all sorts of stuff. So it can be really confusing. Well, on Nadex, all the spreads are all worth $1 per tick, and that tick is always the last digit the spread is quoted in. So the spread price, the bid and ask, the bid and offer, whatever the last digit is, that's the tick. It always moves in an increment of 1. So like on S&P, it doesn't move in 0.25, it moves in 0.1, 0.2, 0.3, 0.4, okay? So, and every time it's worth $1. If you grasp that, you have about 30% of the knowledge you need to understand how spreads work, okay? So every tick is the last digit and it's worth $1. They have a floor and a ceiling. All right, so let's say we're looking at euro dollar. The difference between the floor and the ceiling, let's say, is 2,500 and 2,400. That difference is how many pips? 2,500 minus 2,400 is what? How many pips would that be in difference? So just, like I said, I like to throw some Q&A out there as we keep going. There we go. Awesome, Dave. Good job, Eric. All right, so we got 100 pips difference. Every pip's $1, and so it's 100, and every pip is worth $1, but it's a 100 pip wide spread. Okay, and the spread is the difference. That's why it's called a spread. There's a floor and a ceiling. It's predefined. I'll show you how it's predefined here in a second. It's not like where you go and you pick and you make your, debit or credit spreads type thing. It's predefined. And so being 100 pips, and the last digit, see 1.2500 right there, that last O, that's the pip. Okay, that's the last digit of the quote of the spread. Since every pip is worth $1, the spread itself has a maximum value of $100. Okay, now you can do 1 or you can do 100 or whatever, but has a maximum value of $100. So pretty simple. If you grasp that concept, every pip is worth $1, or every tick is worth $1. It always ticks in an increment of 1, and it's always the last digit of the floor, ceiling, or the bid-ask quote. Same thing. Okay, like it'll always be that tick, and that'll let you know what the spread is worth. Now here's what's really important to start understanding the spreads, okay? If I sell the spread, I can't get stopped out of the trade. It doesn't matter how high it goes up, I can't get stopped out. I can't lose any additional money. So I got it. If I buy the spread, okay, it's the same thing. I can't get stopped out. I have capped risk. So on selling the spread, if I sold it at $24.90, and the ceiling is 2,400, then my risk is 10 ticks, okay, or 10 pips. What does that mean my risk is in dollars on one contract? If I have 10 pips of risk, meaning I can't lose any additional money. If I sold it at $24.90, there's only 10 pips difference. I can't lose anything additional above the ceiling. What's the maximum amount of money I could lose on this trade if it expired, like say at 3 o'clock? Yeah, $24.90 is where I sold it. $2,500 is the ceiling, correct. So what you want to do is you want to subtract $2,500 minus $24.90, and that's going to give you your pip difference, and every pip is worth $1. So if every pip's worth $1, exactly, there we go. Yep, you got it. I'll upbeat, John, good job. Is $10 is my risk on the trade, because I had 10 pips of risk. Now I could have done 1 contract, 10 contracts, 100 contracts, okay? But $10 is my risk on the trade. And I can't get stopped out. Your dollar could fly up and come back down. I come down here, come up here. I cannot lose more than $10. And my margin is the same as my risk. So I'd only be putting up $10 to do this trade. Okay? Meaning, that'd be like, and that's equal to a mini lot. Like a mini lot on euro dollar, which would require you to put up, I don't know, somewhere between $200 and, I don't know, $30, $40, whatever, depending on, where you're at. But the price of it. But you have to put up, a couple $100 to put up a mini lot, which is 10,000 units of currency for a $1 value on Forex. This exact same trade, only $10 that you have to put up. So a lot more leverage and a lot less risk. That's like having a 10-pip stop loss, but no matter how far it goes against you, you can still stay in the trade until expiration. Now, how much can I make on this spread? Now, they have 100 pip wide spreads, 150, 250. They have really wide spreads, okay? But let's look at, this is just a simple like one that they have every 2 hours, 100 pips wide. Sell at 24.90, and they start them, by the way, at 6. So they start at 6, and they have them every single hour. They'll start a new one up for 2 hours. Plus, they'll have like ones that expire at 11 p.m., 7 a.m., 3 p.m., all sorts of stuff. My profit is literally where I sell the most I can make, okay, and the floor. Now, we're going to talk about how to uncap this in a minute. This is how the spread works, okay? And it's like a sort of like a debit or credit spread. You have a cap profit, cap loss, okay? But it moves faster. You got the delta of 1, so it's more like a call or put, like on the day of expiration. So if I sell at 24.90 and the market got all the way down to 2400 or lower, okay, I would make 90 pips. So 90 pips is my maximum profit potential. Every pip is worth $1 because 24.90 minus 2400, that's where the 90 comes from. My profit potential is 90 bucks. So I could lose 10, I could make 90 on the trade. And that's just on one. Again, you can do more, okay? So I know, like, yeah, big traders out there are like $10, $90, seriously? Like, you got other traders like, wow, I can only trade with 10 bucks, that's awesome. So, go by the size of your account, you know, just multiply the numbers. And now, I don't have to hold it till expiration. We'll talk about that in a second, okay? Now, again, I can't make additional money above the ceiling if I bought the spread. So I can sell the spread or I can buy the spread. That's why I don't like that they call them, I don't know, some marketing genius a long time ago decided it was a good idea to call them bull spreads. They're not bullish. They're bullish if you buy them, they're bearish if you sell them. So I can't make any additional money above the ceiling. I can still make money, just can't make additional, meaning like I'll make 90, but I won't make more than 90, okay? So even if it goes way above, it goes up to 2600, the most I'll make is 90. I can't lose additional money below the floor. I can't get stopped out. Okay, so if I bought the spread at 24.10, yes, you could. So yeah. Now, well, maybe it depends on a great comment comes up by Dave. It says, so you could lose 90% of the time and still break even. You could, as long as that 10th one made all 90 pips. Okay, so as long as the 10th one made all 90, because it's not an all or nothing. It's a variable payout, just like just where you buy and you sell. But yes. Puts the odds much better in your favor on your risk and reward scenario. If I bought it at 24.10 and my floor was 2400, I can't lose any additional money below the floor. I could be down 10 pips, but it could come down, 30, 40, 50 pips. I'm still only down $10 and I'm not out of the trade. It could come back up and I can still be profitable on the trade. Okay, so it's a 10 pip risk. Every pip is worth $1, or every tick is worth $1 if you're doing futures. I'll show you all the markets they have. So it's a $10 risk. And I can make up to 90 bucks on the trade. Because if it went, now this is if it was at or above 2,500. Okay? Now, like I said, I can open and close it at any time. So if I bought it at 24.10, and let's say I sold it at 24.30, how much would I make on the trade? What would be my profit? If I bought at 24.10 and sold at 24.30, how many pips would I make? So I would not make 90. Not if I bought at 24.10 and sold at 24.30. I'd make 20. There you go. Yeah, 20 pips. So 24.30 minus 24.10. So let's do another one. If I bought at 24.10 and sold at 24.50, how much would I make? So there you go, 40 pips. Yep. Awesome. Now if I bought at 24.10 and sold at 24.05, what would be my P&L? $5 loss, exactly, yeah. So not a total loss, just a $5 loss. What if I bought at 24.10 and sold at, it got all the way, it expired above, and it expired at 2,600? What would I make? Make 90 pips. Perfect. Yep. So you got it. I mean, that's it. I mean, it's just buying and selling, the difference, except for your ceiling is capped on your profit, your floor caps your risk, or vice versa if you're looking at the sell side again. So let's look at the sell side, do a quick pop quiz. Okay, if I sold at 24.90 and I bought back at 24.70, what would I make on the trade? Okay, if I sold at 24.90 and bought back at, let's say, 24.10, what would I make on the trade? 80. Awesome. If I bought back when the market was at 20, let's say it expired at 23.50, I just held the thing. I went to bed or whatever. The 23.50. What would I make on the trade? 90. Yep, cap out on my profit. If I got in at 24.90, I got out at 24.96. What would be, you know, so let's say it expired at 24.96. What would be my net P&L? Yeah, $6. If it expired at 25.10, what would be my net P&L? Yeah, $10. So loss. Exactly. Where you put 140 pips, I remember my profit caps out at the floor. So even though it went 140 pips, I only make 90. Okay, that's the cap on my profit. And again, I'll show you how to uncap that profit. There's also larger spreads. And it sort of makes me laugh sometimes because people, and nobody said anything like this, but people will say, it caps my profit at 90 pips. I'm like, how many day trades on FX or futures do you capture 90 pips on? Realistically, open to close on a daily basis, on a regular occurrence, you know. I mean, yeah, that's awesome, and but come on, you know, how many are you really hopping in and taking that much out? So is it really impacting you? You know, should we be worrying about capping profits? Not really, but you know, maybe you're a longer-term trader and you want to use these to hedge. Maybe your longer-term positions, things like that. Okay, so that's more where that can come into effect. Okay, so we got the buying, we got the selling. You understand the spreads. You understand you can close them any time. So you can sell and, you know, buy back. And they can come down here and maybe you buy back lower. Or you buy back even lower. It's down here. Maybe you buy it, it's out of the money. It's only, you know, 5 ticks. It flies up and you sell it up here for, you know, close to max profit. You sell here. It goes down. You weren't paying attention. It flies back up. You're like, oh, I better grab my profit while I can. You buy back. Okay? So you can sell and buy back over and over again throughout the trade until the expiration of the trade. And it's really easy to see what it is. I'll show you how a lot of that works. There's a lot of markets, a lot of time frames. Like I said, they have expirations. I have a whole expiration calendar on our website. But on Forex, I mean, it's pretty much every hour on the spreads. They have, you know, starting at 6, they'll have an 8 o'clock, and then every hour they'll have one for 2 hours. Then they'll have a 7 a.m. also. Then at 7, they'll start at 11 a.m. And at 11 a.m., they'll start at 3 p.m. Okay? On futures, they'll have ones that start at 6, futures and commodities. They have some other ones that'll start a little bit earlier, like on the international indices, like around 5, 8, like it's either 3 or 4 a.m. in the morning. And then all the other commodities, except for corn and soybeans, will start at 8 a.m. They'll start having ones, 2-hour ones every hour. A new one will come out until close. And then corn and soybean starts at like 10, 10:30. It's just a weird market. So, like I said, there's little 2 hours up to, you know, about 22, 23 hours there. The longer it is until expiration, the wider that distance between the floor and the ceiling will be, which sort of makes sense because there's more expected volatility over a longer time frame. Okay? So again, the longer there is till expiration, the wider it will be. So instead of being 100 pips, it might be 250 pips. Because it's a longer, like it's one that expires in 7 hours instead of 2 hours. Okay? The FX starts on Sunday. The indices and commodities, they go Monday at 3 a.m. till I think as late as 4:15 on Friday is like the last expiration. Okay? And again, they're all daily or less. All the times are always quoted at Eastern time. A trick for you if you're going to do this, one of the things that I do, I don't live in the Eastern time zone. I live in Texas Central Time. And I change my computer's clock to Eastern time because that changes my charts. I use NinjaTrader. I also use, you know, Thinkorswim. But when it does, it changes my NinjaTrader to show an Eastern time, so my time on my chart matches the expiration times because it's easy to mess up, you know, having to convert the time zones in your head every day. So as soon as you start trading these, if you start trading these regularly, you know, I highly suggest you make sure everything lines up. Also, like most news feeds are like defaulted Eastern time and stuff, so it makes life a lot easier when all your time zones line up. And for me, it's nice because I'm in Central, so every time I walk downstairs at the end of the day, it's like I get a bonus hour. I thought it was 7, it's only 6, or, you know. But you know, it doesn't mess me up too bad to actually do that. And it actually saves me from making a lot of mistakes. Because I used to make some mistakes early on when I traded these just because of time zone conversion. I wasn't thinking like 3 and 3. Oh, wait a minute, that's actually 2. So the range will vary. It's automatically set. I'll show you how it's set. They'll usually have, most of them will have 3 contracts per expiration. Okay, so when a new expiration comes out, they'll have 3 different spreads. And the trading hours, basically the times when trade can be entered and exited before expiration. I've got a question. What's the bid-ask spread? Bid-ask spread, it varies anywhere between, I'd say, 2, and on like less liquid things like natural gas, I mean, it can get like as wide as 10. which is, and it depends on which market you're looking at, but you can see the bid-ask spread. And also the one thing you want to remember, this is something I always point out to people, you're not trading a future contract. You're not trading a Forex pair. You're trading a option. Okay, options have a little wider bid-ask spread because of market makers making markets on those. Now, Nadex is not the market maker. They have no way trade against you. They are just an exchange. But there are market makers and there are other traders on the other side of the trades. So the bid-ask spread is a little bit wider. You can pull up the CME, E-mini S&P 500 options, and you'll see the bid-ask spreads are wider than trading just an S&P E-mini. You can pull up the Euro-dollar futures options. You'll see the options over on the CME are wider than the Euro-dollar future contract itself. So why would you do it? I want that tight bid-ask spread because you put up $10. Your leverage is lower, okay, and your leverage is higher. Your risk is lower. You can't be stopped out. So there's obvious benefits for a little bit of bid-ask spread. So don't get caught up in bid-ask spread unless it really is a killer thing to you. But now, if you're a scalper, and I'll also show you how to use these to scalp, I would not scalp the spreads. I wouldn't try to go in and get out for 10 ticks, okay, or 5 ticks or whatever, because of the bid-ask spread. But you can, and it's really cool. We'll talk about this after we get the hedge down. You can scalp futures and forex, but using the spreads as a hedge so you don't ever get killed on your scalps. Because you get those little, you're going in for 10, 5, 10, 20 tick scalps, the thing goes like 70 ticks against you and wipes out your day. So, and then let's see here. So, hey there, Houston. And then let's see, can you demo trade this? Yes. So you can actually get a demo trading account. So that's under Nadex.com under trading, demo trading account. And we actually show you how to set up the account and how to use the platform. I recommend you use our scanner, which is free. I'll show you that here in a moment. There are no broker commissions, Don. You're direct with the exchange. You only pay exchange fees, so no broker commissions at all. And then a question comes up, can you use Ninja Chart to plan entries and exits on trades? 100% yes. So that's what I do. So I use Ninja Chart to plan all my trades. Like here's, NASDAQ right now. And these are the charts that I use. So we've been long all morning. Right here. So I use this to plan my trades. So yeah, definitely. I 100% recommend you do that. Do not just try to trade it based on looking at the option chain. That would be crazy. Okay, so back on topic here. The spreads, what they do is they have 3 of them. They put 1 above, 1 below, and 1 in the center. Okay? So let's say the market is at 1.3, and there's a 2-hour spread. They're going to put 1 from 1.3 to 1.325. So or actually, this would be a longer-term spread, but 1.3 to 1.325. Okay? And so the floor is 1.3, the ceiling is 1.325. Then they'll put 1 from 1.3 down to 1.2750. So it's always 250 pips wide, say on a 7-hour spread, okay? And then they'll put 1 that's 250 wide, which is 125 pips above where the market is, and 125 pips below where the market is. So you have 1, you have 2, and then you have 3 spreads, and they'll always be 250 pips wide, and they'll be based on where the market is, 1 above, 250 pips, 1 below, 250 pips, and 1 in the middle. The advantage of doing that is if the market moves up, then you could use this one, maybe to sell or as a hedge to keep going long. So, or if the market gets way up here, you could do that. So that's the advantage of having 3 of them. And then they also add in like smaller ones. They'll add in ones that are 8 hours, 7 hours, 6 hours, 2 hours depending upon the market. And as they add those in throughout the day, then maybe the market has moved up and there's not really a great spread for the 7-hour, but there's a great 2-hour one. Okay. I don't know who's hearing background music, but nothing going on here. All right, so, and then they'll have a daily, which will be a really wide spread. You'll probably almost never use it, unless maybe you have a flash crash day and you're like, hey, I'll buy that, thing bounces back. You probably barely ever use the daily spread. The one reason you may use the daily spread is maybe you do want them in the same account, like a trader brought up earlier. You could use just the master spread, which will basically have no premium in it. It'll trade at a delta of 1 to 1, okay? You could use the master spread as your underlying market. So I could buy the master pound dollar spread, which would pretty much be priced right at the market, and then I could sell another spread to hedge it, okay? And then my money's in the exact same account. So that would be a way to overcome that issue. So the reason people may not want to do that is the master spread is also going to expire, so maybe they want to hold a position longer. Another reason, maybe they don't want to pay, $3 or $4 bid-ask spread on Euro dollar. They want to pay 1 pip. or half a pip or whatever. So they want to trade spot, but they want to hedge with the spread. Or maybe they want to scalp, like I'll talk about in a little bit. Okay. They've actually added more pairs too. Euro dollar, pound dollar, Aussie dollar, dollar yen, euro yen. They've also, so they got a pound yen, dollar franc, dollar CAD. They have added in, let's see, what else? Aussie yen, and they've added euro pound now. And they've added a lot, they've doubled volume over 100% year over year. And so they keep growing, and they keep adding more contracts and more expiration times. But like I said, they just added the Aussie yen and the euro pound. I don't think they've made those live on the spreads yet. They opened those about 2 months ago on the binaries. We're still waiting on the spreads. But one thing that's important to note is I say spot FX. Okay, it's not following the futures. That doesn't mean you can't hedge the futures with it. Just understand there's a difference between futures and forex, futures forex and spot forex pricing. Basically, futures forex has what's called the rollover or the carry trade, the carry interest built into the contract as of delivery date. So it'll be slightly different in price. Right now, a lot of them are pretty close just because there's not a lot of interest in the world. But if one of the cross currencies does have a lot of interest, then you can see a little bit more difference. Like in the Aussie, you can see more difference than you can in euro dollar. But it's following the spot FX market. You could still, like I said, hedge futures with it. Commodities, something you drop on your foot is basically the best way to define a commodity. That's corn, soybeans, oil, natural gas, gold, copper, and silver. And then indices. S&P, NASDAQ, Russell, Dow, the FTSE, the DAX, and the Nikkei. One thing, there was a question I didn't, should have added this in. Somebody asked about broker fees. I said there are no broker fees. You trade directly with the exchange. There's no exchange fees. Just to let you know, what are the exchange fees? The exchange fees are 90 cents a contract per side. Okay. If the contract expires out of the money, like let's say you put up $10 risk and you lost all 10 as of expiration, you held on to it and it just went, against you completely, then there is no fee on settlement. And the fees cap at $9. So if I do per order, so if I do one order for one contract, it's 90 cents. One order for 5 contracts, it's $4.50. One order for 10 contracts, it's $9. One order for 100 contracts, it's $9. So they cap at $9. Okay. Let's see here. In standard markets, we're trading against the other traders, often fear and greed. Correct. So I mean that's one of the best ways. All you're really trading in standard markets is you're trading order flow, but because where the orders are is where the markets go. In Nadex, are we trading against statistical probabilities established by Nadex? Okay. No. One, you're not trading against Nadex. Two, Nadex does not make market pricing. Okay. They are an exchange, so they are independent of the trade. They are there simply to facilitate a transaction between a buyer and a seller. On the spreads, it's the exact same thing. It follows the underlying market. So if the market's going up, the spread will rise in value. If the market's going down, the spread will fall in value. Okay. Now, as far as statistical probability style trades, that would be closer to a binary. Okay. So, and that's a whole big topic. Binary is like trading delta and all that, and I can go into that, but I don't want to get us off track. We have a limited time today. But you're not trading statistical probabilities. You're simply trading just like you are trading a future in Forex, and you're not trading against Nadex. They're just the exchange. Okay, so now you understand spreads and how they work, and what they cost, and how you calculate your risk reward, and everything else. And there's a lot faster and easier way to do all that math live. Remember, I said right now my goal is for you just to grab the concept and go, this is worth me spending more time learning. I'm going to show you how to do it a lot easier. Okay, but I want to make sure you understand the concept first, because if you don't understand the concept and then you try to get to the easier part, the easier seems more complex. Okay. All right, so we understand I can buy a spread, I can sell a spread, I have capital risk, capital reward. My P&L is traditionally where I buy and I sell, or it expires, and we understand that I can get in and out before expiration, and then I have multiple expiration times and multiple spreads and multiple markets. So let's talk about how to compare them. Remember earlier we talked about that pound dollar example of looking at the spot versus a Nadex spread. And we were going short here. We put our entry there. We had our stop there. Market, went down. We had $650 in risk. And then market flew right back up, nailed us. We're out of the trade. We lost $650 at a margin of $3,000. And it slapped us in the face. It came back down in our favor. Pain that you were probably feeling. consistently if you're a consistent trader. Or, instead of doing the pound dollar, we could have just sold a spread. 5,700, 250 pips wide, down to 54.50. Still have our same target, okay? We go short on the spread at 56.65. We have 35 pips of risk, okay? So every pip is worth $1, okay? And the ceiling is at 5,700. So that's 56.65, or 5,700 minus 56.65 is our risk. So $35 risk per contract. We did 10 contracts. You could have just done one. So since we did 10, instead of being $35 risk, it's $350 risk. Our margin is equal to our risk, so our margin is $350. And we can make profit all the way down, you know, as much as, the most we can make is down to the floor. Market goes up. Pound dollar trading sitting next to you, in the same trade room as you, watching the same chart as you, taking the same short trade as you. They're out. You're still in, because your risk never increased, you didn't get stopped out, market drops down, you're able to be profitable on the trade, expires at 155.89, and you make $760. Okay? And then spread versus the underlying example. And we do have some advanced order stuff you can learn about VT over at Apex, but not in the Nadex platform itself, no. But hop over to our website, we'll teach you how to do some stuff. So spread versus underlying, the spot versus the Nadex spread. You're risking $650 on the spot, we only risk $350 on the spread, same trade. You put up $3,100 on the spot, you only put $350 on the spread, same trade. You lost $650, you made $760 on the same trade. Okay? Now you also could have just done one of them. So I want to remind you, you didn't have to do $350. You could have done $35. Maybe you only have $500 in your account. You shouldn't be risking $350. Probably should be risking $35. But you know, so you go in there and move down, you make $76. Okay, less your fees. Now you can combine the Nadex spreads with FX or futures as a hedge. I call this the open box or the ultimate hedge strategy. Okay, the reason I call it the open box is because now we're opening that profit up. There's no more cap on your profit, and you don't have to worry about expiration time because you know the spread can expire. You're in profit. You're trailing your stop. Okay, if I showed you like the NASDAQ chart earlier. If I went in over here and I bought this contract, let's say a 10 o'clock expiration contract that expired. Well, that's my trade. Okay, now I have to do another one. Whereas if I bought the NASDAQ earlier and I sold a spread that expired over here at 10 o'clock and the market kept going up, I'm just trailing my stop. Let's use this little dashed line. That's my trailing stop. I'm just trailing my stop and I can continue to ride the trend. I don't have to worry about expiration. So do it on the S&P, the Russell, the NASDAQ, the Dow, corn, soybeans, gold, copper, silver, oil, natural gas, any of the dollar-based pairs. You can do it on the non-dollar-based pairs, but you do have to consider that, and commodities such as FTSE and DAX. Okay, those are going to be in euros, right, or pound. You're going to have the Nikkei being in the yen. So you have to consider FX conversion if you're trying to do them, which gets a little more complex. It's easier just to use the spread. If you don't, now if you want to figure out the FX conversion, sometimes it's so small of a difference it doesn't matter. So say dollar CAD's trading right at $1 anyway, a 1 up, almost 1.0, doesn't really matter. So it may not matter if they're very close, as far as, just, you'd be talking about, pennies or dollars. You wouldn't be talking about a massive difference. But if it is a big difference in the FX conversion, then you would want to make sure you, factor that in. And that gets more complex. But so what is your risk when you do a hedge? Well, if we're going to do a hedge, if we're going to combine the two pieces together, we're going to do a really, really, really tough formula, okay? We're going to subtract where we buy from where we sell. Where we buy the underlying from where we sell the spread. That's it. Where I buy, where I sell, that's my risk, okay? What if I'm going short? I subtract where I sell from where I buy. The difference between the two, because once let's say the bought underlying market gets down to where you sold the spread will be covering you as of expiration as a delta of 1. So you won't be losing additional money as of expiration when it's at or below the price you sold it at. It'll be hedging you, okay? It'll be making $1 for every dollar you're losing at expiration, okay? So if we go over here, let's say I want to do that same trade, but I want to hedge. I don't want to do the spread because maybe this thing keeps going, okay? I don't want to do a spot forward because I don't want to get stopped out. I want to do both because I want to ride this trade as far as I can, and I want to limit my risk. So remember, we had like $650 risk on the spot trade. We had $35 risk on just the spread trade. Well, we're going to go in here. We're going to buy 10 spreads, 5,700 up to 5,950. Okay, we're going to buy 10 for 57.10. So there's a little bit of premium there, like $10 a premium. Okay, so that's why it's 57.10 and the floor is 5,700. And so if I did 10 of them at $10 risk each, that'd be $100 of risk, $100 in margin. Now that's not going to be our risk for the hedge. It'd be the risk if you were just buying the spread. Okay, and we're going to exit if it hits 59.50 because I need to exit everything, right? Because think about this: what happens if the pound dollar goes all the way up? That'd be a big move, be an insanely big move. But if it went all the way up 250 pips or whatever to 59.50, the spread can't make any additional money. It no longer is going to hedge me up there. And you can set take profits on the Nadex platform. Pardon me. You can set take profits. You can have a take profit. I probably wouldn't wait till the ceiling just because, again, like a little bit of premium right there. I'd probably look at getting out around, say like 59.25 or something. So on both of them. All right. So this goes on up, comes on down. You got the spread that you're looking at the same time that you're entering the spread. You're going to go short. Sorry, I didn't really do that slide in the best order, but you're going to go short at the same time you bought the spread. Okay? So I'm going to sell at 56.85 like we did before. I'm going to buy at 57.10 on the spreads. My risk, okay, my risk is the difference between where I sold the FX at 56.85, and which is actually a little bit higher up here, and where I bought the spread at 57.10. That's 35 pips of risk. So that is my risk. It's between where I sold the FX and I bought the spread. Because if the pound dollar started going up, which it did, okay, then the spread is also going up. So if it's up here like 57.20, 57.30, the spread's making money also. All right? And so it's hedging me, like I said, and especially like as of expiration, if you hold it that long, it's hedging me at a 1-to-1 as of 57.10 and higher, because it's making, if it expires at 57.11, if that's where the pound dollar is at expiration, it's going to be up $1. If it's at 57.50, it's going to be up $50. You're going to be down an additional 50. So, but it doesn't hedge you in between where you sold the spot and you bought the spread. So the spread at a certain point, it's sort of like buying a call or put, a little bit out of the money or whatever. You have your premium, which is like $10, and you got your distance. And so like I said, this is sort of like married puts and married calls, but again, for day traders. Now, you can also put these positions on if you're a longer-term trader. You can put one on to help hedge a position off. Maybe you're in a long position and there's a news report about to come out. You throw this on, you're like, I really don't want to get out. I just want to hedge the thing off. It takes off, I want to make some money. So I don't want to hedge it off completely by going long short, like if you're an international FX trader or, the way that people used to do things, they go long short. I want to hedge it off, but if it takes off, I want to make some money on it. But I don't want to get out. And so if it flies down and then, stops, and then all of a sudden I can, take my profit on my spread and, I can move that money over to my FX account if I want to. There's a lot of ways you can use the strategy, whether you're a longer-term trader, you want to have a hedge into the news, or you're just directional, okay? Maybe you're a swing trader, maybe you're a scalp trader. So anyway, so I sell it, and it expires down at 55.89. I made 960 on a risk of 350, so it's a little over, almost 300%. Now I lost $100 on the spread because it expired out of the money. Okay, no fees when it expires out of the money on the exit. So I had the I had the $9 on entry, but nothing on the exit. And so my net was 860. I could have stayed in longer. I could have trailed my stop. Remember, my spread expired, but I'm trailing my take profit. I could keep trailing this thing and keep going because I'm in the FX. Okay? So because the FX doesn't expire. Now, maybe you're a scalp trader. I like to do scalp trading. Maybe you like to do scalp. Maybe you like to go for 10 or 20 ticks. What I'll do is I'll find a line. Like, let's say there's just a great support resistance line in the market. I'll buy a spread right around that area that's really cheap. And as it oscillates, like I'll buy and then I'll sell the FX. And then go down, I'll buy and I'll sell the FX. And goes down again, I'll buy and I'll sell the FX. What if I buy and the thing just keeps going down against me? That's where you get killed as a scalp trader, right? So, well, the cool thing is I have a hedge on. So if it flies down to another area, then I can take my profit on my spread. I can close that out, and then I can put a new position on, and maybe I found another oscillation area, like a pivot point, or I have what's called deviation levels, maybe at fib levels, whatever, where you see the markets bounce and just oscillate. In the day, Friday, nothing's happening for a couple hours. That's a good time to scalp for 5 ticks, 10 ticks. At night, Asia session could be a good time. So after you cover the cost of that spread, as long as you keep letting it drop back down to get in, then you can pretty soon you can actually start putting on trades where now your hedge is completely paid for it. Now you're just trying to make some scalps along the way. So there's whether you're a swing trader, a scalp trader, a trend trader, a longer term trader, there's a lot of different ways to use this hedging strategy to help you out. And again, you could have done a smaller position, and you could have risked, $35 and made $96 with a net $86 after your $10 loss on your spread there. And it's sort of funny. It's good that you lose on your spread. That means your position went in the right direction, and that's ideally what you're wanting. Is you're wanting it to move far enough to cover the cost of that $10 and to move far enough that you can make a nice trade, a nice profit. So now ratios are really important. Okay, now I have all these on our site free. And they're built right into the scanner. But just to give you an example, let's say you're a futures trader. The S&P ticks in quarters. Okay, and this is where it gets really complex. But if you're a futures trader, you get this already. If you don't, you can just stick with Nadex. You don't have to learn any of this. Okay, but if you want to hedge, okay, the S&P ticks in quarters. And yes, we are recording it. I know Morgan's recording it, and we're recording it both. So the S&P ticks in quarters, and it has a tick value of 1250. Okay, so it moves 0.25. There's 4 quarters in a dollar. So there's 4 ticks to a $1 move. And therefore, a $1 or 4 tick move, 4 times 1250 equals $50. Well, the Nadex spreads tick in ones. In US 500, they tick in 0.1. Don't know what the decimal is. It's always a 1. Okay, so 0.1. So they have a tick value of $1 on every spread. Remember, it doesn't matter what it is. It's always a tick value of $1. So if it moves 1 point, $1, 10 dimes, would it be $1? That'd be 10 ticks in a point. So if there's 10 ticks in a point at $1, then that's a $10 move. Okay, so 1 point move in the S&P 500 futures would be worth $50. It'd only be worth $10 on a spread. So how many spreads would you need? It sounds like one of those old college class or SAT test. How many spreads would you need to hedge an S&P 500 future? 5. Perfect. Yep. So because you want to be able to make $50 as a hedge for every $50 on the S&P future. So pretty simple. Now they vary. Okay. And I'll show you the scanner here in just a minute. We're about to wrap up. The hedge is to the floor. If you're going long on the underlying, remember, so it's not going to hedge you anymore when that spread's at max value. Also, think about this. I mean, if you are doing the futures, do you really want to take the full? I mean, yeah, it's there and it's hedging you, but at a certain point, you're wrong. You know what I'm saying? You buy and the market drops 12 points. You're wrong. Let it go. Take your small loss and move on, and see if you can capture a trade making money going back up. Okay? You don't have to take the full loss just because you have the full hedge. And another benefit of that is that means you're not taking that full drawdown in your futures or forex account. Okay? Like if you lost 250 pips and made, let's say, 240 over in Nadex, you don't have to take the 250 pip loss into your forex account. You could take 125 and go, it moved 100 pips against me. I'm wrong. I think it might bounce back. Let's go ahead and put another long on and add another short spread lower so we can hopefully make some money on the way back versus just trying to get our money back. So there's a lot of ways to combine them. But just remember that it does cap out. And like I said, do remember, if you are doing it without the master spread at Nadex or the middle spread at Nadex, and another spread, like if you're doing futures or forex, you need the money in 2 accounts. You need to make sure, even though your net loss may be only $300 or $35, you need to remember you are still having that drawdown on one account, and Nadex isn't hedging against that for you. Okay, it's not like the broker goes, oh, you have short 5 spreads over in S&P, so we're only going to make you put up $50 in margin. No, you're going to take the full loss there. You can take the profit in Nadex. So you may occasionally have to move money between accounts, depending upon how proper you're doing your position sizing. If you're going way too big, then should be where your issue is. But hopefully you're not going too big, and it shouldn't really be a big issue for you. If you have more questions on that, I'll be glad to help. So you need to do 5 ES contracts in Nadex to get the same result on 1 ES futures contract. That is correct. So because a Nadex contract ticks in 0.1, So you would need 5, since it's $10 a point to do that. Now in euro dollar, you only need 1, like 1 to 1 milliwatt, right? Because a euro dollar milliwatt is only worth $1 a pip, whereas a Nadex spread is only worth $1 a pip, so you don't need 1. So you want to make sure you hedge the right amount off. What I personally love about the ability to do smaller sizes is you can do better ratio of your risk. Like let's say I only want to risk 0.2% on this trade, or 2% on this trade. Well, like it might be you have to do 1 or 2 S&P E-mini contracts. You can't do 1.2 S&P E-mini contracts, right? You can't do less of an E-mini than the E-mini. Whereas this you could do like 7 of the Nadex spreads. So you could risk $70 a point versus $100 a point. So you can actually better ratio your risk. And like when you do if you did an E-mini future option over on the CME, you'd buy 1 contract that would equal 50 options. So you'd actually be doing 50 contracts, 50 options, I mean, on a contract over on the S&P E-mini options. So it's just 5 on Nadex. Let's see here. Now the flip side of that, like one of them I think would hedge like, I want to say 10 ETFs on spiders. Okay? So it's all about the ratios. We have the ratios, like I said, built into the scanner. So less time to expiration. This is a big tip for you. I don't need a hedge for the next 7 hours or 23 hours. Okay? I need a hedge long enough to get my trailing stop above break even, ideally above the covering the risk of the spread, and ideally at a little bit of a profit. I don't need to hold on to the thing for 7 hours because I'll pay more time, more premium, so I can get a cheaper hedge that's closer to expiration. I don't need the spread anymore after I move the trailing stop, right? Because at that point, if I'm trailing my stop on my future forex trade, then it's going with it. I don't need it anymore. I don't need protection because I have a stop order protecting me. Now, I'm not saying close it. I'm just saying it doesn't matter that it's expired. Like I got in the trade at 9 o'clock, and it expired at 11, and I moved my stop. I'm trailing my stop. I'm basically protecting profit at this point. I don't have a hedge anymore. It doesn't matter. I have a trailing stop over my future contract that's, locking in or protecting at least my profit at that point. So don't think you have to buy the 3 o'clocks or the 4:15s or whatever, because a lot of times you don't even need them. Now, this is a very cool benefit why I say don't close it. Let's say you're in line doing well. S&P popped up 10 points, but then started to turn around. Okay? And you took profit. You had a hedge on, forex or oil or whatever you trade. And your spread's at max loss. Is there any reason to close your spread if it's at max loss? Like you put up $100 and there's basically like $5 of value in the spread or $10 of value in the spread. Would you have any reason to close the spread? Exactly. So John, 100% right. No, you'd have no reason to close it. I mean, you put up $100 on it and you only have $10 of value, $1 each, at this point. So don't close it. And what may happen? Does the S&P ever go up and down, a couple times in a day? Not every day, but it can move, 10 points up and down a few times, sometimes in a single day. It does that probably about once or twice a week. So you get in, you ride the trade up, you close it out, and if the contract still hasn't expired yet and the market flies back down, you can actually make profit on both sides. So I have traders talk about this pretty consistently. They'll tell me that it's not that they get it every day and they're not even expecting it, but it's like a bonus trade. It's like I took my profit on my futures and then the market went down. I also made money on my hedge, which I didn't expect to do. So when the contract expires, you profit or lose right where it is. So yeah, wherever your profit or loss. So would be the difference between where you bought and sold at a max of the max profit or at a max of the max loss. So if you bought at 100 and expired at 102, you'd make 2 points. If you bought at 100, expired at 101, you'd lose 1 point. If you're just doing the spread. If it expired above the ceiling and you bought it, you'd get whatever the max profit was. If it expired below the floor and you bought it, the most you would lose would be your max risk. If you close it, you do incur a trading fee from the exchange. Yep. So the only way you don't incur a trading fee from the exchange is if you put in a working order, it doesn't get filled, or you cancel it, there's no fee. If you put in an order, you get filled, you're in the trade and it has max loss at expiration. Like if you bought the spread and it expired below the floor, the underlying wasn't below the floor. If you sold the spread and the market expired above the ceiling, then settled above the ceiling at expiration, then there's no fee at settlement. So you need 2 different accounts to hedge. Is that correct? Yes and no. You could just use the Nadex middle spreads or master spreads. So sort of like what I've shown a little bit earlier over here. Let me see, on this right here, you could go in. If I can get it to, there we go, current slide. Trying to get the PowerPoint. So what you can do is optional, is you can go in and you can trade, like say you could buy this master spread and sell a spread to hedge it. You may even buy this spread and sell this spread to hedge it. I mean, there's a lot of different ways. You may buy this spread and sell this spread to hedge it. You know, so you can combine the spreads if you want to. Or if you are going to do futures and forex to hedge with Nadex, then yes, you would need a Nadex account and you'd need a futures or forex account as well. We show you where you can get those accounts. We show you where you can get free data on the underlying markets, where to get free platforms, live streaming futures and forex data. All that's inside of our website. So it's not a hedging margin. You will not get a hedging margin, Dave. No. So if your risk is $50, you're not going to be putting up $50. You're going to be putting up the full margin risk on, you know, whatever the contract is. So if you have to put up, you know, $500 in margin on the S&P futures, that like say at AMP or whoever you use, you'll have to put $500. And then let's say over on Nadex, let's say you have $100 risk on 5 contracts or something, then you're going to put $100 risk. So let's say your net difference is only a $50 risk, you're still going to have to put up the full margin on both sides. Let's see here. Can you explain you need 50 to 1 on the Globex? That's how the contract is built, Arthur. So the S&P E-mini 500 future options, one contract is 50 options. So when you buy it, it'll quote it in a contract of 1. So if I go over here and open the S&P, let's see here. And you also are only going to get like weekly expirations at best. So you're going to have really bad delta and bad gamma. You're not going to get good coverage. Like right here, if I go in and pull up, say, ES, then it's quoting like 4 days out, the closest expiration there is, and then it's quoting me in like a quantity of 1. So it'd be $9 times 50, because it's because of the way the S&P ticks. It ticks in $50 a point, and so therefore they make it a multiple of 50. So Dave, I think I answered your question. So your hedging does not mean margin break. Hedging means reducing risk. So versus margin break, which means getting a margin for doing like say like if you do a cross commodity spread or, you know, cross market spread where you go and you buy this month's soybeans and sell that month's soybeans, you either reduce risk, or if you buy this call strike and sell call strike above it, you know, you put up max risk. So that's a margin break versus a hedge. Like a hedge is just reducing risk. It's not necessarily reducing margin. So you will not get a margin break. All right, so that's all the basic stuff there. The last thing I'm going to show you real quick is just the scanner. Like I said, it's free to use, so feel free to hop in. I'm going to go through, make sure we got all of our things on here. We're talking about scalps. Yeah, we talked about the scalping already. Okay, so we also have the scanner, and I'll open it up live for you since the market's open versus showing you screenshots. All right, so let's go on over and let me open up the page. Let's see this. And once you sign up for a free account there using that link, then just go to Spread Scanner. And under the Spread Scanner, you can pull up, you know, all the markets that are open right now. It actually links directly into Nadex for you. So you can even open tickets there. I'll log in over here to my demo account real quick. And I'm not doing a full spread scanner training. If Morgan, if you want me to do that, we can come back on and do that. But when you open a demo account, they'll put $25,000 of Clay funny money into your account, and we show you how to do that. Also, if you open a demo account and then you open a live account, which only costs, notice how it knows I'm logged in now at the demo. See, so notice I'm not logged into live right here. If you open a live account, the minimum funding requirement is $100, and if you place a trade, whether it's a trade for $100 risk or a trade for $3 risk, okay, if you place one trade, you can then call your Nadex rep up. Just call Nadex up at their phone number at the bottom of their website, and they will extend your demo out for a year. Okay, so even as a live trader, I still use my demo account all the time. So to test things out, test ideas out, stuff like that. So over here, you can go in and you can select a market. What I tell people is, choose live or demo. Okay, at the top. You can also select your default quantity, and I recommend you use Google Chrome, but it does work with Explorer and Firefox as well. We just have advanced features if you use Chrome. And then before you worry about any of this stuff, just hit reset filters. Before you worry about any of this stuff, just select whatever market you want to look at. Okay, so I'm going to select just a couple markets. Okay, so crude oil, gold, and I don't know, euro dollar. Okay. And now what I can do is I can actually see all the different spreads that are available, which is pretty cool, versus you have to click all around inside the platform. If I want to see the spreads, I got to go indices, US 500, and I got to click on each expiration time. Okay? So right here in the scanner, they're all right there. All of them for the entire day. And as they become live, and Nadex, you have to remember to refresh every hour to get the new ones. This will automatically update live for you. Okay? It also does all the math. So instead of you having to figure out what's the max risk, what's the max reward, we actually do that for you automatically, and we build in the exchange fees. So what this is showing you is here are the crude oil contracts, or whatever. Here, let me just make this easier. We'll back down to. The reason I want to show you crude, I want to show you one thing. Over here on the right side, we show you the name of the contract it's following. On the April 2014 contract, here's like the Ninja Trader symbol. Here's like the Think or Swim or month code symbol. We show you what the tick size is in Nadex and what the tick value is, what the tick size is in the future contract that it follows, and what the tick value is, and what the their hedge ratio is. So oil's worth, you need basically 10 oil contracts to make $10 because oil's worth $10 a tick. They tick the same size, so you need 10 of them. And so it'll tell you that all the way down. It'll tell you how many you need on gold. It'll tell you how many you need on US 500, how many you need on euro dollar. Like here it's only one. If you want to do euro dollar futures, it tells you how many you need to equalize it. So that's really handy. And but like I said, let's simplify it down. Let's get rid of a few of these contracts. And now what I do is I go, okay, what do I want to do? Do I want to buy or do I want to sell? Okay. Or if I'm hedging, remember I'm buying the S&P and I'm selling the spreads. So I may go, I want to sell just to see, what the sells would be. That drops all the buys off. All right. And then I go, okay, this is way too much information still. I don't want to look at all this. I want a $100 max risk on a single contract. That'll wipe out some that are like right near the center or all the way at the floor. And now block off. Okay. So now that narrows it down. And then I go, okay, I want to be able to make at least a 0.5 to 1 record ratio there. That'll narrow some down. And then these only have 40 minutes. But maybe I want more time. Okay, maybe I want till the end of the day. Then I can narrow it down even further. And I can select it, and what it'll do is it'll show me the P&L graph on the trade. So on that contract and where it is, how far it is, how much risk am I putting on the trade, stuff like that. And what you'll also see is there's a line right here. This is showing the live market, where the difference is the dark and the light gray. This is where the S&P futures are. Okay. So this sort of shows you where the floor is in relation, or the ceiling is in relation to where the underlying market is. And it'll actually tell you how far away it is. Like 1853 is 33 ticks, which sounds huge, but that's 3.3 points because it's a little bit out of the money. It even tells you it's out of the money. It tells you the risk is $18 on the trade with a $20 on the trade with basically a $280 profit potential. So you don't have to do the math. On Nadex, you wouldn't have to do the math, but you'd have to do it manually, or you'd have to open the ticket up and then choose a contract to get the math for that one trade. Okay? And then it'll also tell you what your risk-reward ratio is in the trade. One of the most important things, they'll tell you the proximity to underlying, because this is the biggest mistake new Nadex traders make. If they go in and they're like, $5 risk, that's my trade. Okay? They're all about that. They don't realize that the ceiling of this trade is down here at 1850. Okay? And the market is like at 1857 right now. Okay? So the market had to drop 7 points before they even break even on their $5. So pay attention a lot to this proximity. But what's really cool is as you pull it up and you do it, you can, and that might be a good hedge. Maybe you want to, Mike, yeah, he brings up a good point. It could be a catastrophic insurance policy you could put on there. Just a really, really cheap hedge. But if you're willing to take a 7-point stop. But I tell people don't focus on the filters. Focus first down here and figure out what you want to get rid of. I want to get rid of the buys. Say I want to get rid of anything that expires in less than, 2 hours. Then I could say minimum 120 minutes. I want to get rid of anything that has more than $100 risk. Then I put $100 up here. That type of thing. So you can go through and you can do a lot of different examples. We could flip it around maybe to the buy side. See if, is anything following that criteria. You could also view multiple markets versus on Nadex, you have to flip between each one, not only every expiration time, but also every market you have to individually look at. So I can watch euro dollar, pound dollar, and pound yen all at the same time if I want to. I have all of them right here. We also have one for the binaries, but obviously that's not our topic of the day. And so say I'm looking at euro dollar. So here's live spreads, and I always hit reset filters at the beginning. It's your reset filters, okay? And I go, do I want to buy or do I want to sell euro dollar? And I don't have a euro dollar chart open at the moment, but if I did, I could tell you. Let's see here. We got euro dollar. Okay, so I had a long. I'm actually just now getting it set up for a short. So we'll see how that goes. So I have a potential setup for a short on euro dollar. So I go, okay, well, I want to sell. And I go down and look at what's available. I'm like, okay. And then, this was like 20 ticks from the market. I don't want that trade. So I can actually choose at the market. Okay. And it ought to, drop that off. So now it only shows me ones that are 10 ticks or less. So that's how far it has to move basically as of expiration for me to be break even. And then I don't want to be putting up $300. I don't even want to put up, maybe I do, maybe I don't want to put up $100. That's my choice. But let's say I don't want to put up more than 150. Okay, so I can say max risk 150. And here are all my choices. I got 1 o'clocks, I got 2 o'clocks, I got 3 o'clocks, all of them. And it's doing all the math instantly for me. What's really cool, what I noticed out of the gate, okay, I'll show you this. It's one of my favorite things about the scanner. Both of these trades have a ceiling of 137.40. Okay, right here. They both expire at 2 o'clock. Actually, no, this one expires at 2. This one expires at 3 o'clock. Okay? They basically have the same distance to break even, and they had the same risk. I mean, $9 versus $10. Okay? But since this one is a long, the reason it's 250 pips wide is because it started at 7 a.m. Same ceiling, basically same risk, same proximity, but it has $237 profit potential. It's a wider spread. That one only has 89. I'm not really putting up any more money to choose this trade. There's no reason I would do that 2 o'clock trade. I get another hour. If I'm hedging with it, if I'm buying the euro dollar, it's a better hedge. It gives me more protection without me having to pay more money. Okay? So, there's a lot in here, and I mean, we have to do like a whole scanner training to go through it in detail. We do have a scanner training actually built into the website. So right up here under scanners, Nadex spread scanner right there. So I walk through all this more in detail for you. The most important thing right here that you want to do is, if you're going to use it for hedging, I'll teach you a simple trick, okay? For hedging, because that's our main topic. If I were to buy, remember if I said if I bought what would my hedge risk be? It'd be just where I buy the euro dollar and where the euro dollar spread is, where I sold it. So where I buy the FX and where I sell the spread. So if I bought and the euro dollar is currently at 37.35 and I sold this at 37.30, okay, I have about $5 in risk on the trade. So just it's a very, very simple way to see what your risk would be. And then add in bid-ask spread. There's a couple ticks of bid-ask spread. And so what I've actually learned, what's really helpful, is, and this is a little bit weird, okay, so if you hold on with me on this, when you're hedging, okay, when you're buying the future and selling the spread, or when you're selling the forex and buying the spread, or whatever, your proximity becomes your risk. So I actually have about a 7-tick risk, which lines up. If you look at 2 to 3 ticks bid-ask spread, and the market's currently quoting, it says the indicator is 37.35, basically 37.36. So 37.36 and a couple ticks bid-ask spread, I have $7 in risk. So the proximity is my hedge risk. And then my risk, right here, this is about my break-even distance. Okay? Because this is how much I need to make on the euro dollar to make back my risk. And to make $10. And it's already in the money. Because see how the floor is a little bit below where the market is. So I could look at this and go, okay, my risk on this trade, this euro dollar trade, if I bought euro dollar and I sold the spread, is $7, and my max risk, or my actual distance to break even, is 10. So I'm only risking $7 on the trade between now and 3 if I want to go long, and if it moved up 10 pips or more, I'd be break even, and then beyond that, I'm profitable. So versus if I go to buy euro dollar right now and have a 7-tick stop loss. So it works out a lot better than just doing the underlying spot by itself. But this tool, if you'll spend a little bit of time on it, will make life 100 times easier. Because when you go over here and you try to figure out the spreads, and you're trying to analyze all the different contracts, you got 3 here, 3 here, 3 here, you got 1 right there, so you got 10 contracts. You're trying to figure out what the best one is in real time and do the math. You can see why I built it. And like I said, there's no cost. It even, like I said, even opens up directly. You can open ticket up right there in the platform. The way it does calculations for you is we're actually getting all the information from the Nadex exchange through an API feed fed directly into our server. We're doing all the formulas and spitting it out for you. So it's all the math that you have to do, like what's the price minus the floor, what's the price minus the ceiling, all that stuff, what's the difference between the underlying and where the market is. All that math is being done live for you and fed right in. As a process, do I suggest entering the hedge first or trade first? I personally enter the trade first, and then I enter my hedge. And I try to do it at the same time. I have my ticket open, and then so I enter the DOM, and then I'll hit the hedge. So the reason I like doing that is simply because usually I don't want to lose out on that bid-ask spread tightness on the underlying market. Yeah, you can do a partial hedge. I've even seen people do the other opposite. I've seen them do a larger hedge, like they'll do 15 contracts instead of 10. So if it goes against them, they actually can make money. So it has to move a little further for them to cover that extra cost. Minimum account size for Nadex is $100 for a live account. So yeah, we'll have to do a follow up on the scanner. So I need to spend a little more time to go into more detail on that. So sorry about that, Russ. But if you hop on the website, I do have a video on there, and I also have live webinars on Thursday. I can go through that in more detail, and I'll do another one with Morgan, and we'll go through it in more detail as well. All right. Yeah, there you go. Yeah, there's the demo account. So definitely get that, and then if you want to get access to the scanner and the forum and all that stuff for free, hop on over to apexinvesting.com/pub and to sign up for a free account. If you already have one, just log in. And we have a forum, by the way, if you have any, pardon me, if you have any questions. There's even a forum for the scanner. So it says like scanner tutorials and facts. Click on that right there, and you can ask all the questions you want. And I'll be glad to help you with anything that you need. All right, well, I'm going to hand it on back over to Morgan. So we took it sort of slow until at the end we did a little like run through on the scanner really fast. But I appreciate everybody's time, and hopefully you learned a couple new things today. So.
Great, thank you, Darrell. Really appreciate you being here. I know that we've never had a comment after one of your presentations that it was short on information. So I know Darrell can talk fast sometimes, but that's why we record it, and you can yeah, you can nobody ever feels shortchanged. But yeah, it's definitely some new information, and I think that as you guys use the demo and kind of get to learn that. You'll have the opportunity to really practice this in an actual account. And like Darrell said, there's you can start out with putting $100 in the account. I typically recommend $500, but if you just want to put $100 in there just to see how it feels, you can do that. So we appreciate you guys taking the time to be with us today, and look forward to seeing you on the next event. We'll get the recording out to you later today. Thanks, Dave. Thanks, everyone. Thanks, Maverick. Appreciate you guys being here.